While you were finishing your weekend, scrolling past headlines, something far bigger than a campaign promise quietly moved through the system. A single executive push that redirected hundreds of billions of dollars before Asian markets even opened. At 12:01 a.m., a plan emerged from Washington, a 10% cap on credit card interest, a $200 billion command to Fannie Mae and Freddie Mac to buy mortgage-backed securities, and a restriction aimed directly at institutional investors holding up to 20% of single-family homes in certain U.S. markets. On the surface, it's called an affordability agenda, lower rates, cheaper mortgages, relief for households, but behind the language of protection, banks modeled a 5 to 18% hit to pre-tax earnings, mortgage spreads compressed overnight, and capital began repositioning ahead of what Wall Street understands very well. This is not about kindness. This is about who absorbs the loss and who captures the upside. Because when government-directed capital enters the housing and credit markets, someone always pays and someone always profits. The question is not whether rates fall. The question is where the money goes next, and why your monthly payment is now a bargaining chip in a much larger transaction, and nobody is talking about what it actually means for your wallet. This is not a collection of random policies. It's a familiar structure, a repeatable framework insiders recognize instantly, an economic operating system quietly deployed when markets seize up and political pressure peaks. Stage 1, financial isolation, not against a country this time, but against a class of actors. Credit card margins capped at 10%, mortgage spreads compressed by $200 billion in forced demand for mortgage-backed securities. Capital that once flowed freely is suddenly constrained, rerouted, or frozen in place. Stage 2, narrative control. The language is affordability, fairness, level playing fields, institutional investors framed as distortions, banks positioned as obstacles. The public story becomes moral, while the mechanics remain mathematical. Stage 3, strategic intervention. Fannie Mae and Freddie Mac step in as buyers of last resort, not the Federal Reserve, not technically quantitative easing, but government-sponsored entities expanding balance sheets on command. Rates move, spreads tighten, markets react before legislation even exists. Then comes stage 4, resource reallocation. This is where the headlines stop and the contracts begin. Capital exits unsecured credit, rotates into rate-protected assets, defense against policy risk, while housing inventory, pricing power, and mortgage liquidity quietly change hands. This system doesn't destroy wealth, it transfers it predictably, efficiently, and once you see the pattern, you realize this playbook didn't start here, and it never ends here. To understand where this ends, you don't start with speeches, you start with balance sheets, currency flows, and contracts signed quietly after the cameras leave. Case 1, Iraq oil and the dollar system. In the late 1990s, Iraq sat on roughly 115 billion barrels of proven oil reserves, but the real rupture came in 2000, when Saddam Hussein announced Iraq would price oil exports in euros, not US dollars. This wasn't ideology, it was accounting. Oil priced outside the dollar system weakens demand for US treasuries, and by extension, America's ability to finance deficits at scale. Within 3 years, financial isolation was complete. Sanctions tightened, assets frozen, trade channels restricted. Narrative control followed. Weapons claims, moral urgency, televised certainty, then strategic intervention reshaped the power structure, and almost immediately after the regime collapsed, Stage 4 activated. Oil contracts were redistributed. ExxonMobil, Chevron, BP, Shell, production sharing agreements rewritten. Iraq's oil returned to dollar pricing, and the euro experiment quietly disappeared. Stage 4 complete, pattern verified. Case 2, Libya, gold and monetary independence. Libya held 143 tons of gold reserves, and Muammar Gaddafi's proposal was simple but destabilizing: a gold-backed dinar for African energy trade. Oil priced in gold bypasses both the dollar and the euro, a parallel settlement system beyond Western control. Again, financial isolation arrived first: sanctions, asset freezes, restricted access to global finance. Narrative control followed swiftly: humanitarian language, urgent timelines. After the power structure collapsed, Libya's central bank assets were reorganized, gold reserves vanished from public accounting, and foreign energy firms returned to negotiate access. Not speeches, not ideals, just contracts, custody, and control. Stage 4 complete, pattern verified. This is why modern interventions rarely look like invasions. They look like rate caps, bond purchases, regulatory definitions, cleaner, quieter, but built on the same operating logic. Now bring that operating system forward to today, because the language has changed, but the mechanics haven't. Stage 1 is already live. A proposed 10% credit card rate cap, even for 1 year, compresses margins across JP Morgan, Bank of America, Capital One. Analysts immediately modeled a 5 to 18% earnings impact. That's not politics. That's capital being cornered. At the same time, $200 billion in mortgage-backed securities purchases executed through Fannie Mae and Freddie Mac forces yields down without the Federal Reserve touching a single lever. Liquidity injected, spreads narrowed, asset prices supported. Stage 2 is running in parallel. The narrative is affordability, fairness, first-time buyers, institutional landlords framed as distortions, while executive orders redefine what a large investor even means. Stage 3 is subtle but critical. Banks are encouraged to voluntarily comply. Waivers replace mandates. Lobbyists rotate through Washington. Defense and infrastructure stocks quietly outperform as policy risk rises. Then comes stage 4, the part that never trends. Capital rotates out of unsecured consumer credit into energy, infrastructure, rate-insulated assets. Private equity adjusts housing exposure, and long-duration contracts begin to surface, quietly, methodically. This is not chaos, it's choreography. Peace isn't announced on television, it's priced into bond spreads and locked into 99-year agreements long before the public understands what changed. This is the part no press conference walks you through, because while systems rebalance, households absorb the friction. If credit card rates cap at 10%, banks don't disappear, they reprice risk. Credit tightens, approvals slow, limits shrink, the cost doesn't vanish, it relocates. Mortgage rates may dip briefly, but inventory doesn't magically expand. Institutional buyers step back, construction lags, and first-time buyers find themselves competing inside a narrower window under a ticking clock. Gas prices don't respond to speeches, they respond to energy contracts, shipping insurance, and geopolitical hedging. As capital rotates into hard assets, fuel becomes a volatility sponge, and inflation leaks back through essentials quietly. Your 401k feels this next. Banks rebalance away from consumer credit. Pension funds chase yield in energy, defense, infrastructure, sectors that thrive on uncertainty, not stability. And then comes the most dangerous illusion, the tax refund windfall. Nearly $200 billion in household refunds projected, spent into an economy where supply chains are still repricing risk. They win by mastering volatility. You lose when prices adjust faster than wages, when purchasing power erodes while markets celebrate growth. This isn't accidental. It's how large systems convert policy into profit and households into buffers. By the time most people notice change, the transfer has already happened. Rates move first, capital follows, headlines arrive last. This pattern doesn't require villains, only incentives and systems that reward those who move before permission is granted. You can't vote this operating system away. You can't pause it, and you can't outsave it by accident. Because the real wealth transfer doesn't happen during crisis, it happens during intervention, when volatility is framed as protection, and balance sheets quietly rewrite ownership. The pattern creates the wealth transfer. You can't stop it, but you can see it coming, and when you see it early, you don't panic, you reposition, because the next stage is never announced. It's priced in. Subscribe, not for opinions, but to stay ahead of the money before the next system update goes live.